I want to talk about what you see coming next, this movie that you see coming. Just for our viewers who aren't aware, you gave the narrative leading up to the credit crisis. You were calling subprime an unmitigated disaster before it happened. You played defense for your clients.
Unmitigated disaster, and it's going to get worse.
Yes, in June of 2007. Right. And you played defense with your clients, and then you played offense in 2009.
Right.
But you say that there's another one coming, this movie, a turning, if you will, fourth turning, if you will. Explain what you are seeing.
Well, when you talk about a fourth turning, there's this sort of political philosophy that says that the world moves in cycles, and there's basically 4 chapters in the cycle. And the first one is the building of institutions with tremendous confidence and buy-in from the public. And then when you get into the fourth turning, which is where we are now, you basically have the public rejecting institutions. And the way society operates gets out of sync with the institutions. It also ties into Karl Marx's philosophy, where you have the means of production and the property relations. And the means of production can have innovative change that's really revolutionary, like the internet, like social media, like radio, like the telegraph, like the railroad, like television, and all that stuff. Well, this time it's social media and the internet, and it changes the means of production tremendously. Just think about what will happen when we have driverless trucks and driverless cars. You're going to put thousands, millions of people out of work that have no skills other than to be a chauffeur or a livery driver or a truck driver or what have you. And those people just get left behind by the revolution in the means of production. But the property relations have to do with how the wealth is split up. And they're and power. And they're very slow to change. They don't change in a revolutionary way. They even resist changing in an evolutionary way, because the people that benefit from the property relations and have the power, they don't want to give it up. So what they do is they pretend that you can somehow keep things together, even though there's a tension developing between the means of production and the property relations. Look around at how things are out of sync right now. People are running for president, trying to say billionaires should be illegal. We should eliminate all billionaires. We should be, putting free money into people that have been displaced by the revolution in the means of production. And the people who are in charge, some people call it the deep state, some people call it the establishment, whatever you will. Some people call it, you could even call it churches, that their ideologies that existed even 20 years ago have been completely rejected. So what has to happen is we need to have a new set of property relations. And that is absolutely the kernel beneath the changes in the political system in the United States that Trump obviously dialed into. And now you see the Democrats are really not a party anymore. The Democrats basically have a socialist party, and they've got the keep the genie back and get the genie back in the bottle part of it, which is Joe Biden and perhaps Michael Bloomberg. And none of these factions can get majority support. So that's emblematic of a fourth turning. And what it means is that we have to have something resembling a revolutionary change in the property relations of the world. And that's a really big deal. So historically, what have fourth turnings led to? Turmoil. The Civil War in the United States was a fourth turning. World War II was a fourth turning. So it doesn't have to be violent like a war, but it has to be a complete rejiggering. Think about what happened pre-Civil War and post-Civil War. Mm-hmm. I mean, there's a huge change, and then actually the South managed to sort of put the genie back in the bottle with Jim Crow, and it actually lasted a long time, but even that now is echoing and being ripped apart. So we will have very substantial political change. I saw a leading Democrat, not one that's running for office, actually say that if the Bill of Rights, the first 10 amendments of the Constitution, the Bill of Rights, were voted on today, significant fraction of it would be voted down. That was his viewpoint. So the level of tension is palpable. And all you've got to do is look at where we are. It would be great if we could have a time machine where you could go back 20 years in time, and I think you wouldn't believe your eyes at how different things were 20 years ago versus today. But you get these things very gradualistically. It's kind of like the tires on your car is the analogy that I use. You know, you drive your car for like however many miles your tires are good for. Let's say it's 25,000 miles. You don't realize how bad the traction has become because you've experienced the decline so gradually. And then you get the new tires, and you're like, wow, I can't believe how well this thing handles and the traction in the car. Well, that's kind of how this has developed. It's so slow. And so where we are in terms of disunity, I think would be remarkable in the eyes of somebody from 20 years ago.
Well, I want to ask you, from an investor's perspective, how do you see this playing out? What do you think happens?
Well, we are battling tooth and nail the next recession. The Fed has done, and the central banks have done everything they can to avert the next recession. But a recession will come. And when it does, that's when all of this stuff will accelerate into kind of the parabola. And that's why you should be playing defense right now, just like you should have been in 2006. You were early. I think playing defense is early. You probably should have started playing defense in 2018. And the fact that 2019 has been really good is just a better reason to play defense, because the next opportunity is going to be in corporate credit. Not what happened. You never have the same crisis twice. Mm-hmm. But if you look at the growth of the corporate bond market, it's more than twice the size of the United States as it was in 2006. And as we know, through the prism of 2009, people said, oh, that debt was really ridiculously high. We never should have allowed that to happen. Well, now it's twice as big. And we have zombie companies that are allowed to keep going because of these artificially low interest rates. And the corporate bond market is probably significantly overrated, which sounds a lot like subprime in 2006. Some of them were rated AAA, and they fell to 20 cents on the dollar. So they obviously didn't deserve a AAA rating. Right now, there are leverage ratios in the investment-grade corporate bond market that suggests that nearly a third of the investment-grade corporate bond market probably should be rated junk right now. But they've been given a pass because they say, well, like AT&T is one of them. They've given a pass because they say, well, we know that we have excessive debt. It's kind of imprudent, but we know about it, and so we will be addressing that problem in the future, and they're being given a pass. Well, when the recession comes, there won't be any idea of addressing these leverage ratios. They're just going to get a lot worse when the recession comes, and you're going to see en masse downgradings of the investment-grade corporate bond market. And trust me, when a BBB rated bond gets dropped down to a single B rating, the price doesn't go up.
Right.
The price goes down. And that, I think, will lead to very significant divestment of a lot of the naive money that's gone into the corporate bond market, because it's been a pretty smooth ride for the last 10 years, and it's been pretty rewarding this year as well. And so I think a lot of money doesn't understand the risk that exists in corporate bonds, particularly when the next downturn comes. And so I think that corporate bond exposure should be at absolute minimum levels right now. And I also think that non-U.S. exposure should be ramped up to maximum levels. For people that allocate globally, I think they should be moving towards the minimum of their range, whatever that number is. If they say the minimum that we're going to have in the United States is 40%, they should be moving towards 40%. If the maximum in foreign assets is supposed to be, I don't know, 30%, you should be moving towards 30% and playing defense. And then when the opportunity comes, you'll want dry powder to be able to pounce on it. If you underperform during this late cycle kind of end game, you're going to get caught, because once bonds in particular start to drop, I have a saying, in bonds you make money slowly and you lose money quickly. It's like they go from, making money is going from the bonds going from 100 to 103. Losing money is the bonds go from 100 to 50. And so you want to be there with dry powder to buy the 50, and that means selling the 103.